Well, good evening, everyone, and welcome to the Brian Crombie Radio Hour on Saga 960. I had the pleasure, the honor, frankly, a year ago or so of interviewing John Ruffolo, founder and managing partner at Mavericks Private Equity, a very impressive entrepreneur, venture capital investor, formerly of Omer's Ventures and the co-founder of the Council of Canadian Innovators, about his career, about an accident that he had, that he's come back from, his resilience. And it was really quite an inspiring interview. And if you get a chance, if you haven't had a chance to listen to that, I commend it to you. I might post a link to it again. But I wanted to talk to him tonight because just a week ago, he wrote a really interesting piece on the top 10 things to do as an entrepreneur in navigating the storm. And we are, I worry, headed for a storm. And I'll ask John about this. But with interest rates on the rise, with the World Bank saying that it's going to be difficult, if not almost impossible, to escape a recession, that some people talking about stagflation as a potential, having someone like John give us some advice on the top 10 things to do as an entrepreneur to navigate the storm, I think it's really helpful. John, welcome to the show tonight. How are you, sir?
Good. Thank you very much, Brian. It's a pleasure to be here.
Thank you for joining us. So tell me about some of the top 10 things that you think we need to do as an entrepreneur navigating the storm.
Sure. And what I think the best way to think about this is separate. There's two pieces to the storm. The first one was highly predictable. The second one is not. The first one is the rise of interest rates. And all that's happening is interest rates are rising sort of back to where they should have been in the first place. What we've experienced really is the artificially low interest rates since 2009 and during the financial crisis, and really led by the U.S. Treasury Department in buying back U.S. government bonds, which is really an indirect way of printing money. And what it did, it artificially kept interest rates low. What happens with that? It artificially increases asset prices, housing prices, stocks, private company values, etc. And one of the results of this is, and it took a long time to happen, is you start to see inflation starting to creep. And when the Ukrainian war came, it really moved at a much, much faster rate. And by the way, this interest rate creep should have happened a couple of years ago, but COVID really delayed it. So what we're seeing first is just really the right sizing of valuations of various assets. And these are things that really are just more of a fact of life. It's the second part that is concerning. And, the various governments are continuing to increase interest rates in order to slam down inflation. And the problem is, do you slam it too hard and dip the country into a recession? Personally, I think we're already in a technical recession. We only have one more quarter to prove it out. The question for me, at least now, is not if we're going to be in a recession, but how severe it is. And the article that I wrote was really dealing with the second part. And there are a number of issues to watch out for, and also opportunities for the future.
Opportunities for the future. So that's interesting, because some people think that that bad economic times with low valuations in the stock market are great opportunities for people that are expansion growth oriented.
Correct. So let me give you the bright side. The best, most sustainable companies have generally weathered through a very deep and painful recession. New companies and new startups, frankly, some of the best ones like Shopify really took formation during in their case, they technically started in 2006, but it wasn't really until 2008 and 2009 where they really started to form their business model. Why? What happens? Well, there's not a whole lot of customers, and you better be profitable very, very quickly. And there's not a whole lot of capital around to invest in your business. So guess what? You actually build a business that actually makes money that customers want to pay for. And also during a recession, what happens, and what's happened here in particular in the technology sector, very, very difficult to find talent. When the market contracts like this and you start to see layoffs, there are plenty of jobs available in the winners. So you're going to see a migration of talent starting to coalesce around, the stronger companies.
We're chatting tonight about what to do in tough economic times if you're an entrepreneur with John Ruffolo, who has written a really interesting piece that he posted on LinkedIn about some of the lessons that he's learned over his investing career. We're going to take a break for some messages and come back more with John in just 2 minutes. Stay with us, everybody. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. It's a real honor of mine to interview again tonight John Ruffolo, who is the founder and head of Mavericks Private Equity. He's a gentleman that I pitched a couple of times. He probably doesn't remember it, but I pitched him a couple of times when he was at Omer's in private equity. He's someone that I've followed, and I think lots of us in the Canadian market have followed his successes and also, frankly, some of his challenges, and have been impressed about how he's dealt with some of his challenges in life. And looking forward to what you're going to do with Mavericks. But this article is the topic for today's conversation. And you're talking about how valuations have come down, as they probably should. You say valuations have come down 35% on the NASDAQ in technology, only about 20% or so in the balance of the stock market. And I understand that private market valuations haven't come down as of yet. So what do you think is going to happen in the general stock market? There was an article in the Globe and Mail just this weekend that suggested that there was maybe another 15 points to still come in a drop in the basic marketplace, and that private market valuations hadn't really caught up yet to the public market valuations because entrepreneurs, I guess, are resistant, and people like you are resistant to book those revaluations as of yet, down rounds, as I think they're called. What do you think is going to happen in both the regular stock market or the major stock markets? Are they going to follow the NASDAQ, and in private market valuations?
It's right, and I'll speak more specifically to the technology or technology-enabled businesses as opposed to all businesses in general. But I would agree with the sentiment that let's start off in the public markets. The prediction that we made based on the valuation adjustments does suggest that there is still more to go down from a valuation perspective. It hasn't quite reached the long-term mean of valuations, but it's getting very, very close. And for a lot of the technology stocks, we're really talking about, if you remove a few outliers, we are talking about on average about 50-ish % drop. On the private
50%, I thought it was 35. That's significant.
Yes, and when you look at the marquee names from their peak valuations, many of them are far past 50%, and some as high as 80-85%. But you'll see a number of them still quite haven't been repriced fully. But the private markets usually lag the public markets, not because they don't experience the same drop. The answer is they do. The issue is whether the investors or the entrepreneurs want to recognize that loss. It's the equivalent of you investing $100 and the value of the stock going down to 50, but you not wanting to sell it because you're going to lose $50. Well, you've lost the 50. You just haven't realized the loss. It's the same analogy in the private markets. But make no mistake, those valuation drops are there. And in the marketplace, you are seeing monstrous reductions in some of the big brand names. Like in Europe, the biggest tech company there, a private one, was called Klarna, and their valuation, I forget the exact number now, but it's dropped 75, 80% valuation drop on this next round. And the key always has been is cash is king.
Right.
And the problem with so many of these companies is it's okay not to be generating cash flow today, but you've got to have some reasonable expectation in the future. And so many of the companies that I've seen, you cannot possibly see it ever being profitable, and it will require a monstrous amount of capital. And bizarrely enough, the market was overvaluing these businesses. These businesses should have been valued at zero because they're not businesses and they will all go bankrupt. And that's the problem. It got insane. And if you're an entrepreneur, you got to take it. But the investors deservedly are taking it right on the chin because they got caught up in this FOMO frenzy of trying to be the next investor of a unicorn that they created in their own mind.
So private market valuations are going to come down, bottom line. Now, you also talk about the IPO window is going to be closed, and you say for a year or two.
Yes. Well, here is the sad reality. So again, I'm going to use technology companies. There's this rule, we call it the rule of 40. And what you do is that you add the growth rate of the business plus the EBITDA percentage. So EBITDA as a percentage of revenue, you add those two numbers and they need to be at least 40. From 2019 to 2021, there was about 20 IPOs in Canada of technology businesses, and all of them are underwater. And we did a report on it, and I can't remember offhand, but 17 out of the 20 were grossly underwater, where no one other than the very earliest investors would have made money. What's the bottom line? These businesses were too small. They weren't ready. And the problem is it's now created this taint. And a lot of investors don't want to be embarrassed. So unless someone has a great private company to go public, it will go public. But there's so few right now that are really truly targets, and people feel burned. And the investor who really got burned, unfortunately, all the time is that retail investor who kind of comes in at the end and loses their shirt because they're fed a story. Certainly they want to get in on the action. So, maybe there was a little bit too much greed there, but they're being fed stories. And I think that retail investor is going to be highly cautious for the next number of years.
Well, a lot of those retail investors have just lost 30, 50% of their portfolios.
Correct.
So they're going to have less cash, less capital to reinvest.
Yeah. And, let's pick another industry, the crypto industry, right? There's an industry that I've spent, almost 10 years in, and very, very hard to price, the value of Bitcoin or Ethereum. But again, people were investing well beyond what they should have as a percentage of their net wealth. And now with a lot of loss of capital by those investors, they're not coming into the technology ecosystem anytime soon.
Well, I got to ask you, you may not follow the market as closely, but what about real estate? People have talked about it potentially being a bubble. Looks like volume is down, but prices, at least recorded prices, haven't gone down yet. Though I get an email today about new price, better price. Yes.
So it's just a mathematical equation on the interest rates. And again, so Canada and the US are a little bit different. So in Canada, there is a disproportionate number of let's use residential real estate, that have variable rate mortgages. So in Canada, as the rates are going up and the interest rate is resetting, the pinch is starting to be felt. And exactly what you just said is, I think right now, last data I've seen, the increases have stopped for sure. And you're seeing the softening in certain markets. But I do believe that there will have to be a decrease because it's an inverse equation of the increase in interest rates. In the United States, they have far more fixed interest mortgages. So there'll be a little bit longer lag effect. And as I understand it, the mismatch of supply and demand of housing has been more acute in Canada than there is in the United States, certainly compared to the crisis of 2008, 2009. So the pundits in the space are betting that Canada is going to fare not so well. And in the US, with the exception of certain heated areas, will have a more muted impact.
Though, the Sunday New York Times this week had a full big 2-page spread on the coming demise of real estate market in the United States. So some pundits in the United States are saying it's going to be pretty bad there too.
Yeah. The Sun Belt areas, like I'm watching very closely myself personally, and I get a notice when there is decreases. And I would say to you, I didn't get any about 3 months ago, and I am getting about 3 to 5 a day. And the average decrease on the pricing is 10 to 15%. Now, their original offers were, I thought, egregious in the first place, but it seems to be a standard 10 to 15%. And this was in the Florida area. So, I think certain areas for sure got way overpriced, but we'll wait and see. But I would be surprised if there was not a material impact to residential prices. We're seeing it on the commercial real estate, certainly, just because of the vacancy rates, particularly in B and C class buildings. There is no question those values are coming down materially.
And then you also said, sort of, I guess, as an opposite impact, that acquisitions by foreign-based acquirers and buyout private equity funds are going to be on the rise.
Yes. So let me speak to first on the private equity funds. So the last 10 years, I spent my career as a venture capitalist and was taking advantage of the rise in prices. And starting in 2019, I thought it couldn't get any higher and flipped and went to the private equity side. And I think what's going to happen is private equity buyers, whether they're a buyout firm or a minority investment firm like Mavericks Private Equity, we're looking at public companies for the first time in years. And the funny anomaly is, remember when I said about the lag of 6 to 9 months? Entrepreneurs or investors who are not recognizing that the value of their private business has decreased and are being stubborn about it, there is some great buying opportunities on public companies at valuations that are significantly lower than the private counterparts. And in particular, where there's big dry powder is US-based private equity. And I have to believe that they're looking at every single private or public company in Canada right now. And with a nice currency advantage, those public companies will look very, very cheap. So, and I'm going to expect that in Q3, Q4, probably beginning of Q4, we're going to start to see a lot of this transaction activity occur. Right now, people are a little bit skittish and just hoping to avoid any falling knives or over the next 3 to 6 months. And then you're going to see the activity go.
We're going to take a break and come back, and we're going to ask John to walk us through the 10 things he thinks we should do given the situation that he's just described, that the storm is either here or is coming. And he's got some really good recommendations on what to do. And remain calm is the first one. So we're going to come back in just 2 minutes and ask John about that. Stay with us, everybody. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. We're talking about what to do if you're an entrepreneur coming into this storm of a recession, potential stagflation, decreased stock market valuations, potentially reducing private market valuations. Our guest is John Ruffolo of Mavericks Private Equity, former founder of the venture capital arm at Omer, someone who has been a great spokesperson for investing in entrepreneurial ventures, technology ventures in Canada over the course of the last couple of decades. John, one of the things you say right off the bat is to stay calm. It's obviously pretty difficult to do so. And, maybe we can actually come back to some of your personal challenges, but, where does calmness, where does, the ability to resilience, to stay calm through the toughest times come from?
Yes. So, number one, as if you're the leader of your particular company, whether you really know it or not, everybody on your team is looking at you. They're looking at everything that you're saying, your body, language. And if you're not remaining calm and thinking through how to weed through make your way through the storm, they're going to panic. So you need to get yourself together first. And, in the event that you might have to do layoffs, or you need to cut your cash, the biggest thing is communication with your team, and to over communicate. They have massive anxiety. They have, families to feed, etc. And don't try to paint a rosy picture. If you be honest, they will understand what the company is going through, and it's never fun to cut team members, but in many cases, it's necessary. The one thing I didn't say in the article, which is one big lesson, is once you figure out what your strategy is and right-sizing the business, try to cut once. And if the number is 20% cut, I actually even push folks to say, maybe make it 25%. I know that sounds kind of cruel, but what it does do is it assures the team that once you make that one cut, that's it. And everybody else go back, to business and execute the strategy. Otherwise, and I'm seeing a bunch of companies do it right now, they're cutting by 1,000 cuts, and everyone in the organization starts to become worried. Are they next? So that's the real issue about calmness and really understanding the strategy and how to get to the other side.
I think it's a great suggestion. I used to work for Jim Pattison. You probably know him by reputation.
Yes.
And I worked for him during a recession. And his comment was, cut early, but cut once.
Right.
And I think that's good. But I think the other thing that you talk about is really anticipate. And, one of the things that, people didn't do, I think, early enough in the pandemic was do a what if scenario. They sort of thought it was going to be over too quick, and they didn't. Then they just sort of hunkered down and waited it out rather than thinking through what they needed to do to withstand a longer term pandemic. And so therefore, if we're looking at a recession that might be shallow, might be deep, and higher interest rates, you got to do those what if scenarios of what if this stuff happens and what are you going to do? And I don't think enough people do that, frankly, early enough in the cycle. And then I guess the final thing, you talk about over communicate. before the interview started, we were talking about Rogers, and one of the things that they did not do, I think, is over communicate.
Yep.
Lots of public relations people have been talking all weekend long about the mistake they may have made in not really communicating. And the joke is the communication they did do was probably not on the Rogers system. So
yeah, I saw that. Yeah, it's communicating that I don't know yet is absolutely fine. But for God's sake, say something. Tell people what you're doing, the methodology that you're using, the reevaluation that you're going through. And, the team will be behind you. Obviously, it's not fun for people that might get cut, but it's absolutely critical. And again, you'd be surprised at the number of companies that will actually get stronger once they actually get through the recession.
Yeah. Number two, you said, was to ensure alignment with your investor stakeholders. And you talk about that you've got to understand what motivated their investment in your company. And then you talk about that you need to understand their expectations in regards to things like dilution and
yes.
a cram down round. Explain to our listeners, if you could, what a cram down round is and what dilution is, and how it impacts your investors and what you got to do with that.
Yeah. So and I'll give just a numerical example. Let's just say that prior to a year ago or so, an investor invested $100 in the business and gave it $1,000 valuation. So right after putting the money in, that business is worth $1,100 in my example. And now another investor comes in today and looks at the business and says, no, this business is not worth more than $1,100. In fact, it's only worth $500. So if you want another $100 in your business because you need it, now the investors who thought that they had shares that were worth that $1,100 are basically being cut in half, and they're basically losing approximately 50% of the value of their investment. So that's the dilution. Now, in some cases, the dilution could become very extreme. So in that example that I just gave, and say the company needs another $100, I might say something like, you know what, I'll give you $100, but I'm going to guarantee that the first $300 of value of that business goes to me. So I'm going to guarantee a 3 times of my investment. And it might mean that all of the other shareholders might end up with 0. So that's called a cram down, where I'm cramming you basically to 0, even though you've given money before. And that is an extreme case, but that will happen. Probably within the next 12 months, we're going to see a lot of this stuff. We're seeing lots of dilutive rounds right now. But the point really being is for a company, if the company survives and the employees continue to operate there and it gives the lifeline to a business, that's a good thing. So that's good for the company. It may not be good to the investor, but that investor made a foolish decision to invest at such a high valuation in the first place.
Right.
And a good investor will say, you know what? I goofed up. I overvalued it. I'm going to still try to help this company. And maybe try to get as much value as I can in the future. But I'll recognize that it's important to me that the company stays afloat. Problem is, ego sets in, and a lot of these investors don't want to admit that they made a foolish investment decision. So they pretend it's still worth $1,100 and will block any new investors for putting any money in at a valuation less than that $1,100. What happens? Company goes bankrupt.
I had another boss that once told me that too many people think investor relations is only important to try to get your stock up. It's even more important when your stock goes down.
Yeah, For me, the definition of a great investor is watch their behavior when times are really tough. And I could tell who's really a good investor or who's an imposter.
An imposter. Interesting
Yes.
comparison. Number 3 was assess and keep a tight rein on your cash position. When I was in the biotech business, it was always that you had to have 2 years of cash on your balance sheet and or enough cash to make it to your next valuation inflection point.
Correct.
What do you think the right amount of cash is, or is there rules of thumb?
Yes, there's a rule of thumb that you want to have at a minimum. So 18 to 24 months cash for a technology startup has been the rule of thumb prior to 2019. Between 2019 and 2021, Jesus, they had 6 weeks of cash. People were raising capital, which was insane. But 18 to 24 months, recognizing that it takes approximately 6 months to raise capital. So if you have 18 months of cash, what it really means is that you really have 12 months of cash, because once you have 6 months left, you are in a very, very bad position, because it'll take you 6 months to raise the capital. So I always like to have anywhere between 18 to 24 months of cash on a balance sheet, for each fundraising round.
Suggestion number 4 was ensure your business generates positive unit economics. And I love this quote that you include in your article. As the saying goes, we lose money on every sale, but make it up in volume was never intended to be a business model. So I guess what you're saying is that too many companies are losing money.
Well, but they're losing money on a gross margin basis. It's unbelievable. And I see these things get funded, and they were some of the most massive fundings. Now I picked on one in the article, the 15-minute delivery companies, and I'm sure there's going to be one that's going to perhaps figure it out, but they were losing money on every single sale. And then below the gross margin line is, your other costs, your administrative, your selling, etc. But if you don't have a positive gross margin, how are you ultimately ever going to get profitable? Now, people will point to 2 famous examples, Amazon and Netflix. Yes, it is true. They actually had negative unit economics, but we just picked 2, and maybe there's a few other ones. And Amazon got through in the skin of their teeth when they did a massive debt financing. I can't remember the exact year, but it was early 2000s. And Jeff Bezos said that's what really saved them and avoided them to go from going bankrupt. And anyways, a lot of those businesses that I've seen being financed with negative unit economics, if you don't have positive unit economics, like, you're done. And no smart investor is going to bother investing in you. And if you can't fix that, frankly, just hang up your cleats and go out of business.
Number 5 is probably the one that most people think about, which is review opportunities to reduce your costs. And you quote Neutron Jack from GE that made famous the practice of cutting the bottom 10% from his organization every year. As I mentioned, I used to work for Jim Pattison, and I asked him about that. He joked that his rule was the bottom 10% of his sales organization he cut every month. And so that was a little bit extreme, but it was interesting because, the way that, and he did not do this just in tough times. He did it all the time.
Correct.
He thought he was giving people a better opportunity because they clearly weren't working out with him, and that if he cut them loose and gave them an opportunity to find where they really were going to be successful, that they'd be better off. And also, I think that one of the challenges that we have is that if you keep, those poor employees around, it really impacts the whole organization. And
yes.
So, making sure that you, reward those A employees, and you've got to always have, I guess, some B, but getting rid of some of those poor employees is key. And you make the point that, cutting a whole bunch of the other expenses may not make a dent. Regrettably, too often it's got to come in headcount.
Yes, and I was speaking specifically, on technology companies, because the vast majority of the costs are people costs. What happens too is in really good times, and when you're getting lots of capital, you're hiring folks and you're still, flipping around different strategies. And so you hire some folks based on one strategy, doesn't quite work. You do a second strategy, hire some more folks, and then you start to get corporate bloat. And you never quite go back and say, wait a minute, the strategy that I no longer am executing, what were those people for again? Oh yeah, let's try to move them someplace else, but that's not what they were hired for. And so people don't really go back in really good times and kind of clean up things and just tighten their belts. So it is very good hygiene to do this really in good times and in bad. And in bad times, you just have no choice but to start really cutting so that you could at least cut the fat in the organization.
Number 6 is reevaluate your organic growth strategies to ensure steady, sustainable growth. I think, too many people don't have really good organic growth strategies and are reliant on acquisitions. And so that's a basic recommendation.
Yes. So, there are businesses whose entire strategy is predicated on acquisitions, but it's not really then, a business per se. It's really a merger and acquisition machine, and that's what really the business's core competency becomes. And there's some successful businesses that have done that, but for the most part, if you could take care sustainably organic growth strategy and then supplement it with mergers and acquisitions, that's a superior strategy. And I do find that a lot of organizations, when I go through their organic strategies, it's not as tight as it really should be. So, as an example, do they have a direct sales force? Are they using a channel strategy? Does it depend on the product or the service? Does it depend on the geography? You don't need to build everything, and there's pros and cons of each of the various strategies. And in many cases, you might have an indirect channel strategy that eventually morphs into a direct sales strategy. But I do find that a lot of the businesses grow unnecessarily. And again, it starts creating a lot of the cost bloat as well.
Number 7 is consider buy versus build versus partner strategies to achieve strategic objectives. I mentioned Jim Pattison a few times already. He really wanted to build up cash during bad times, cut costs so that he could build up more cash because he saw it as the best possible buying opportunity that you're ever going to get.
Yes. So this is where I get very excited. So, and I give the same instructions to the companies in which we've invested in that, we're trying to keep lean and mean, and we're evaluating our core businesses versus those parts of the business that we don't have to operate. And we could either buy a company or we could partner. Let's talk about the buy. Well, I talked about the valuations. Well, in the businesses that perhaps didn't manage their costs very well, but have a good product, or maybe it's a company that has a good product or a lousy product, but a good sales force. The valuations now to buy those businesses are far more attractive. So the ones that are holding onto the cash now during the recession are going to come out of it so much stronger if they're being very strategic in their acquisitions.
We're chatting tonight with John Ruffolo from Maverick Private Equity about how an entrepreneur must deal with the coming recession storm, decreased valuations, et cetera. And he's got some great recommendations of what to do. We're going to take a final break, and come back with the last 2 of his recommendations in just 2 minutes. Stay with us, everybody. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. My guest tonight is John Ruffolo Maverick Private Equity. He's a former founder of Omer's Venture Capital. He's the founder and head of Maverick's Private Equity. So he's gone from VC to PE. And he's one of those people in Canada that people listen to because he's quite renowned for his investment talent. Number 9 is determine whether you have the right mix, quantity, and quality of talent. And you talk a little bit about checking to see if you've got too many layers, to see if you've got the right people that are going to, from an organizational design perspective, be able to take your company forward. And then I think you comment, which I really find interesting, that the war for talent might become better for employers in a recession. And so therefore you might be able to take advantage of that.
Yes. So I was trying to make a couple of points there. So first of all, the war for talent, there will always be a war for talent for exceptional employees, particularly with unique skill sets. But for the last number of years, the power has been with employees, and the power pendulum is going to swing. And again, the layoffs of a lot of businesses have really started over the last couple of months. And, you're going to see a stronger stream occur. And already we're seeing folks who are high quality folks being picked up by other firms who are perceived winners, who will hopefully be a whole lot stronger as they come out of the recession. So this will be the first time we're going to see this in about a decade. So it's going to be quite interesting. And we're going to see how this all works with, the whole remote workforce and the flexibility of people moving, et cetera. So it'll be very, very interesting to watch. But number 2, and this is something that organizations don't do enough, is really review their organizational design. And by that, I mean is that you look at each span of control of each individual, starting from the CEO downward, and trying to understand the direct reports that each one of them having, to ensure that it's not too many, but it's not too few either, and ensuring that the KPIs, or the key performance indicators, are passed down throughout the organization. And what you really are trying to identify are areas of bloat in the organization, or folks that are really not really involved in either the decision making, or really the maintenance or the management of other employees. And you're really trying to see, have you inserted too many layers in the organization as well, and trying to find that right balance. And this is a very good time to do that. And that's how you will quickly start to see your excess fat in the organization.
Your last recommendation is don't be a hero. What do you mean by that?
Well, this is complex. So none of this stuff is easy. And I have the benefit of seeing lots of great CEOs do this, but this is a team effort. This is when the executive team together needs to come together and to deliver this and pass this down to the organization. And by don't be a hero is, if you're the CEO or the founder of the organization, don't put the weight of this, of getting through this solely on your shoulders. Number 1. Number 2 is your health is critical. So, this is not a time to be working 24/7 either. So you need to make sure that you're both physically healthy, you're mentally healthy, and frankly, spiritually healthy. And this is good for everybody, but in particular, it's good for your own family, because if you're not happy there, then frankly, your ability to execute at work is going to be constrained.
John Ruffolo, founder and head of Maverick Private Equity, thanks so much for sharing your thoughts with us. I read this one report once that said something like 4 of the 5 largest family wealths that were ever built were initiated in tough times. And I'm not sure if that statistic is right or not, but it suggests that the tough times are tough, but the people that can take advantage of it might actually turn out pretty good. So thanks for those recommendations on the things we need to do. I really appreciate it.
All right. Thank you, Brian. My pleasure.
That's our show for tonight. Thanks so much for joining us, everyone. I remind you, I'm on every Monday through Friday at 6 o'clock on 960 a.m. You can stream me online from anywhere in the world at www.saga960am.ca. Thanks, John. I really appreciate you joining us tonight. Good night, everybody.